When it comes to retirement planning and managing your assets in retirement, we all fear a big drop in our market value. And that's a valid concern, but there are ways to avoid that. And today's video, we brought in Brett Martinson, who is a CFP professional on our team here at Parallel Wealth, to talk about preparing your investments for retirement, the changes you need to make, and how to make sure you position yourself in a great position to give yourself the cash flow that you need. I always tell clients, in retirement, we don't want any period of time where you don't take money out of your investments to do the trip you want or anything like that. Throughout your retirement, you're going to see years of market dips. You're going to see a 10, 20, 30% dip multiple times. So how do you prepare for that? So let's welcome Brett to the channel as we dig into how to prepare your investments for your retirement.
So Brett, thanks so much for joining us in this video. It's great to have you back on the channel. I know we've done a few videos in the past, but today we're talking about withdrawals for retirement. So my first question for you, and as you know, you guys prepare plans for our clients, is what are 2 to 3 ways people can prepare their investment portfolio for retirement? So maybe give a couple examples around it as well.
Sure. So 2 or 3 ways I would say that they can prepare. The accumulation or contributing to your investments is different than withdrawing or decumulation. So in terms of preparing for withdrawing and preparing retirement, the key is that you don't want the money that you need to withdraw in the next little bit to drop 10, 20, 30%. So the main key there is just the money that you feel you're going to need or a plan shows that you're going to need should be sitting in something basically not guaranteed to drop. So that would be cash, that would be a GIC, something in those kind of areas, so that $15,000, $30,000, $80,000 that you need to pull out of your various investments is not participating with the market going up or down. The other couple things they could do is ideally they're starting to plan for this about 3 to 5 years out. They may not be implementing anything at that point, but at least they're, for example, talking with their investment advisor. We could do a whole video on the investment advisor should be talking to them, but we'll leave that soapbox for a moment. And just whatever you can let your investment advisor know about in terms of, yeah, retirement's on the horizon. It's probably 7 years out, give or take. It's now 5 years out. Yeah, I think I'm going to pull the plug in 2 years. And then the final thing is when you are getting close to implementing, and I would say close to implementing being hopefully, ideally, a couple of years before retirement, is then, especially if you have all your investments in one fund, like, a balanced ETF or whatever you want to call it, you'll probably want to think about separating those out so that the money that you're withdrawing isn't all wrapped in that one fund. Because when I sell that balanced ETF, I can't pick and choose if I'm selling the cash portion, the fixed income portion, the equity portion. I have to sell virtually a proportion of all of it. So those would be certainly 3 things that they should be considering and thinking about to prepare themselves.
And some people call that the cash wedge, right? Like have a cash wedge, which is, we've seen a million different terms for that, but we really harp that on our clients too. Like, here's your plan. Like, here's how much investment or cash you need out of each different income bucket. Now, make sure that your investments actually line up with that, right? And in a perfect kind of plan and implementation, a 10, 20, 30% drop in the market shouldn't actually affect you in retirement. You prepared for that. And for most of the people watching these videos, you're either in retirement or getting close to it. You're thinking about retirement. And the reality is people are going to face 2, 3, 7, maybe even 10 market corrections of 10, 20% or more through their retirement. So it's not if, it's when. And so it's, in my opinion and your opinion, and we do this day in, day out, it's actually quite easy to avoid market corrections in the drawdown of retirement, as long as you have a plan and as long as you actually implement it with your investments. Brett, would you have an example of maybe a client that we've worked on in the past where they were maybe in a bad position for retirement? So not necessarily like bad investments, but just bad structure heading into retirement with regards to their investment portfolio.
Sure. I can think of, quite frankly, a number of clients, specifically more time frame than clients, but I'll get into clients in a second. But if we look at like the first 6 to 9 months of 2022, when the market went down and then pretty much stayed down, and then it was in 2023 it started to climb up, give or take, depending on what you're invested in. I know that around the office we were getting a lot of people asking for plans, and the first thing they were saying was, where should I be taking my money from? I'm in retirement, I'm about to retire in 3 months, and all my money is down. So that's an example of where their investments probably were not structured properly for withdrawals, because if it was structured properly, and I totally get where they're coming from, but if it was structured properly, you probably wouldn't be having that question, because you would have so much in cash in your non-registered, so much in TFSA, so much in RSP, if you're planning to withdraw from those accounts. And then they could be withdrawing from that cash. I tell clients, for example, we're talking 5 to 10% of the value or the net worth, or excuse me, the investment assets, whereas the other 90-ish% is still focused on medium to long-term growth. We're not throwing everything into bonds and GICs. It's just what's coming up in the near future. So in terms of time frame, that would be an example. And in terms of a client coming to us and doing a plan, it's pretty much similar. For example, they may have all their money in dividend investing. That's been something that's been talked about a lot. There's nothing wrong necessarily with dividend investing, of course, but if they're not prepared for the capital to go down, and I always use banks as an example, I can't think of the last time a Canadian bank went bankrupt. Not that they couldn't, but I can think of lots of times where the Canadian banks went down 10, 20, or 30%, not because they weren't profitable, but just because they were riding whatever was going on with the market at the time. Yeah. So certainly, yeah, structured in the fact that they were basically structured for growth. They were doing what they've done over the last 10 years. They were structured for growing, and they didn't slice off that small piece of the pie to be structured for withdrawals.
Yeah. And not that dividend stocks are a bad investment. In fact, they can be a really good investment, especially in retirement, because they're providing that consistent cash flow. But absolutely, unless the dividends is giving you all the cash flow you need out of your portfolio, which typically it's not in retirement, you need to complement it with other things. But it's just a fluctuation. A lot of people do head into retirement with a large basket of equities, and they just haven't prepared fully for the cash flow. The other one we've seen, and this was one of the very first clients I remember we did many years ago on a plan, they had a lot, if not all of their money in private equity. And so they were looking to retire in the next 12 months, and all of their money, like, 7 figures, was locked in for 3, 5, 10 plus years. Yeah. And they kind of said, like, well, how do we retire? And I said, like, you're going to have to see if you can collapse some of those investments, that kind of stuff. So just be aware of, like, the type of investment you have. Are you locked into it for a period of time? And this is where I say, like, people always ask, like, when's the perfect time to do a retirement plan? And I say 5 to 10 years is kind of that sweet spot, because it gives you a bit of a runway. Yeah. And part of that runway as you get closer to your retirement, like you said, Brett, is just to make sure that things are set up for day one of retirement. Whereas if we do a plan, and we do a lot of plans for people retiring tomorrow or early in retirement even. And it's like, okay, yeah, we'll show you how to plan and get stuff on track. But if you need cash flow next month and you haven't prepared for it, it might be a little more challenging, right? So that's why having a bit of a runway does definitely help.
Yeah, and just to touch on that point about like, some people may think, well, 5, 10 years before retirement, that seems like a lot. We have to also remember that part of retirement is what you're doing leading up to retirement. So as you well know, we can identify, hey, maybe you actually want to slow down your RSP contributions, because you're getting to a point where it's going to be tough to get all this money out, and you are probably going to be taking it out at a higher tax rate than you're putting in. Or you're not using RSPs or spousal RSPs as effectively as you could be, or whatever combination of that might be. But the fact that we're suggesting 10 years before is not because that plan is going to be perfect for the next 10 years. It's to prepare you no differently than, saving for a house. You don't start saving for a house 6 months before you buy the house. Hopefully, you start a little bit before. So same idea.
Yeah. Well, nowadays you start 60 years before you buy it.
Well, yeah, exactly. Yeah.
Last question I have for you. How should a person integrate their retirement plan with their investment? So basically someone has a plan. How do we kind of implement that and structure that going forward?
Sure. So kind of dovetails back to the last one, is that hopefully it's been done before retirement is hitting. And as we said, not only far looking into the future, but also hopefully about a year or two before retirement, you've got that plan set up so you can start to prepare. And then specifically looking at that plan, and let's say it says you're going to need or should be taking $20,000 out of your RSP, RIF, LIF, whatever combination of that. Plus, you're going to need another 30,000 from non-reg because of what you want to spend on, and taking more out of your RSP or RIF is just going to cost you more tax than you need. So we've got these numbers from these different buckets, ideally RSP, TFSA, and non-reg, and their various components. So that $20,000 in that taxable registered column, again, should be sitting in something that ideally is guaranteed not go below zero. So yeah, it's not going to be exciting. It's not going to be sexy. It's going to be cash. It's going to be maybe GIC, as long as you're not locking it in. This is to your point of locking in. You know, we're not going to put it into a 24-month GIC when we need it in 8 months. And same thing with non-registered, so that we've got the money in those accounts that's still growing for the long term. But if that money goes down 10 to 30%, we've got that other buffer there. And if we need to access that buffer, great. If the markets are up and it seems like a good idea to sell from some of your up investments, then that buffer just exists for next year, and can be tweaked for that. So ideally, and the other thing, again, reviewing the plan with their investment advisor. I suggest that for two reasons. One, I think, is the obvious, but review the plan with your investment advisor so they're ready to kind of be prepared. But also, it might give you a sense. Some investment advisors are great at accumulation, some are great at decumulation, some maybe are great at both. But we know, and I'm sorry?
Or bad at both. But
yeah, exactly. Yeah. But we know that we've seen a lot of questions around, well, why are you taking money out of your RSP? Or yeah, you can do a 50% unlocking, but you can't unlock the rest, when you can unlock the rest if it's under the small balance rules, allowance, different names for different jurisdictions. So it might give you a sense that maybe that investment advisor doesn't have the knowledge and expertise to say, oh, I understand exactly what's going on here. I've got a few comments, but I know where the planner is going here.
And one thing we do with a lot of our clients that kind of partner with us on the planning, and we refer out to BCB Asset Management, which is one of the investment firms that we kind of partner with and recommend and refer to, in that, for our clients that are retired, they look at it as, okay, here's your portfolio. Now they do a dividend approach. So all their stocks that they own pay dividend. So let's say the RIF, we need to pull 30,000 from the RIF next year for a client, and every year going forward, they can say, okay, well, we have 15,000 coming in through dividends. So let's just make sure we have, another 15,000 in a maturing bond every year. So regardless of what the market's doing, the dividends are coming in, the bonds are maturing at, face value, and market fluctuation is alleviated from the stress and part of the plan, but long-term growth potential is still there. So lots of things to think about. So we'll wrap it up there. Brett, thank you for joining us in this video, for your insight. And for those of you watching the video, as you get closer to retirement, the mentality, and the old school mentality, is real, I need to scale back and move, move to more bonds or fixed income. There's truth to that, but it has to integrate. Doesn't mean you have to take less risk. Yeah. You just have to restructure stuff for cash flow. And I do a lot of videos on this channel on cash flow, and cash flow is king. And this is another example of that. So Brett, thanks again. And we'll do this again soon.
You bet. No problem.